So finally, we come to my most favorite financial statement, cash flow statement. Cash flow statement actually answers a very important question. Is it possible that your company or your business is making profits in the income statement, but it is losing money in the process? This is one of the most important questions which you need to answer. Now, a cash flow statement is divided basically into three parts. Number one, cash flow from operations. Number two, cash flow from investing. And number three, cash flow from financing. These three parts of the cash flow statements makes the whole cash flow statement. As you can see from the name, we will go through these parts individually and take examples through Excel and real life companies. Just a very simple brief. Cash flow from operating activities, like the name suggests, it states how much cash company made or lose from operations. Right? So let's assume that if Apple has operations of selling iPhones, then how much cash, I'm saying cash, not profit, how much cash did Apple make from its operating activities? The cash flow from investing is basically says, it's all in the name, how much cash company invested in the business or take investment out of the business during the period. Cash flow from financial activities, every business can be funded through debt and equity. So how much cash company raised or paid back to debt holders and equity investors. So these three parts, cash flow from operating, investing and financing activities, tell you the entire picture of the cash flow of your business. One of the most unique things in cash flow, which is not found in any other statement, is that it does not follow the debit or credit format. It does not follow any assets or liabilities format. It shows minus or plus as cash in and cash out. In that way, it is a very intuitive and very simple statement to understand. If the figure is negative in a cash flow statement, it simply means that that is cash out of your business. And if the figure is plus in the business, and if the figure is plus in your cash flow statement, it means that it is cash in your business or cash inflow of your business. That is why it is quite logical for you to understand a cash flow statement as a business owner. And the best part, cash flow is not meant for anyone. It is only made for owners of the business. So let's see the first part, the cash flow from operations. Like we did in the income statement, here is a generalized format of the cash flow from operations. It starts with net income. Net income means profit or income after taxes. So it starts with the last figure of the income statement, that is the net income. And why? Because it is the income available for equity holders. Then what we do is we add any non-cash expenses which are included in our income statement. Why we are adding these non-cash expenses? Because this is a cash flow statement. We are not bothered about finding the profitability. We are concerned how much cash has been generated by business during the year. So for that purpose, we add any non-cash expense which have been debited in our income statement. After adding our non-cash expenses, we do something called working capital effect. Now, this thing will be discussed later in details, but it basically means how much cash has been increased or how much cash has decreased due to my changes in working capital. What is working capital? Working capital simply means current assets minus current liabilities. Current assets means account receivable or debtors, accounts payable or creditors, your inventories, and if there are any change in deferred taxes. Deferred taxes are nothing but just a non-cash entry. So if there is a change in deferred taxes, this will also be included here. See, we are not talking about the proper income tax paid to government. We are just talking about a general entry which is called deferred tax in the balance sheet. So when you do all these adjustments, you get something called cash flow from operations. Effectively, this is the cash which is available to equity shareholders from operations. Now, one more thing when we will see the practical examples of these cash flow from operations, you will see that certain other expenses will be added or certain other items will be added or minus in the cash flow statement. So let's see a very simple cash flow statement using an Excel example. So here is a cash flow statement as on, let's assume 31st December 2022, and we are calculating only and only the cash flow from operating activities. Let's assume that we have a net income of $100 million or $100 during the year 2021 to 22. This net income is taken here. From that, we will add our all non-cash expenses. Let's assume that non-cash expenses during the year consist of depreciation only. So we add the depreciation part and we add $10 of the depreciation. Let's assume it was a $10 depreciation. Now comes the working capital effects. Like I said, there will be non-cash expenses needs to be added and the working capital effect has to be plus or minus. So how do you calculate working capital effects? Well, working capital effects are very simply taken from the balance sheet. So what we do is, from the balance sheet, we look at the current assets and the current liabilities. Let's assume that in our balance sheet, for simplicity purposes, we have accounts receivable as current assets, inventory as current assets, and accounts payable as current liabilities. So what will happen? In the balance sheet, we will take 2 years balance sheet. That is 2022 balance sheet and the previous year balance sheet of 2020 to 2021. Now let's take the first example. In the first example, our debtors or our account receivables have reduced by $25 from the previous year. In the previous year it was $100 and in this year it is $75. So what does this mean? It basically means, if you think about it, if we reduce your debtors, how your debtors are reduced? Well, your debtors are reduced because they paid back the amount owed to you. So what happens is, when your debtors or your current assets get reduced, then it results in increase of cash flow in your business. Let me repeat it again. When your debtors are being reduced or your current assets are being reduced, then it means that those assets, those debtors are basically being converted into cash because those were current assets. This get converted into cash and this resulted in cash increase in our business. So decrease in current assets or decrease in debtors resulted in a $25 cash inflow in our business. Now for the first timers, it can be a very difficult concept to grasp, but try to understand that whenever you are reducing the current assets, you are freeing the money or the liquidity in your business, and that increases the cash. So that decrease in debtors has increased our cash. Similarly, now comes our current liabilities. Our current liabilities have increased from $100 to $135. That means that our current liabilities have increased by $35. So what does this mean? It basically means that during this year, I have taken $35 extra goods from my suppliers and I have delayed making the payment to those suppliers. That means that my cash, if I had paid the creditors, then I had to reduce my cash. But since I have not paid my creditors, it has resulted in increase in current liabilities and accordingly my cash flow will increase. So when my current assets are reducing, my cash flow is increasing. And when my current liabilities are increasing, my cash flow is increasing. If it was a different case, that is, if my current assets were increasing, let's say inventory. So if my inventory was in 2021 was $100 and in 2022 $150, that means I have purchased additional inventory of $50 during this year. And this additional inventory, what it has resulted? It has resulted that my cash, my business basically has put extra cash in inventories. So this resulted in cash outflow of your inventory. So that is why this increase in inventory has a minus figure, that is minus $50. So all of these figures, when you basically make a combined total of these figures of plus and minus, you get net cash from operating activities as $120. So you see, the net income of our income statement was only $100, but our cash flow has increased from operations by $20. Why? Because of all of these non cash and working capital changes. And this is what I want you to understand. There is a there will always be a possibility that your net income will be different from the net cash from operating activities. Why cash flow is important? If you ask me which is more important, income or cash flow, I will say it is more about cash flows than income. Why? Because income doesn't tell you the whole story. Income statement is absolutely essential when you need to know that you have a good business model or not. But when it comes to running your day to day business, there is no statement more important than cash flow. And in cash flow, the cash flow from operating activities tells you how efficiently and effectively you are running your business. So the cash flow from operating activities is basically being computed by taking the net profit, adding back the non-cash expenses, reducing the cash flow if the current assets have increased, increasing the cash flow if current assets have decreased, and vice versa. If the current liabilities have increased, that means I have deferred my payment in the future and thus result in increase in cash flow. And if I have paid my current liabilities, that means I have reduced my cash from the business and this resulted in decrease in cash flow. So this is how you calculate cash flow from operating activities.